The second method of valuation of goodwill is weighted average profit method. It is a method under which weight is assigned to each year. Normal business profit for each year is multiplied with the assigned weight to determine the value, that is weighted profit. So here for each year the weights are given and these weights are multiplied by the amount of profit of each year, and the resultant is called the weighted profit. Weighted profit as well as the weights are totaled, and the weighted profit and the weights are added. Total of weighted profit is divided by the total of weights to determine the weighted average profit. More weightage is assigned to the profit of recent year as it indicates the most likely profit in future, and the profit of the recent year means just previous year is given the biggest highest weight because it indicates that the same profit will be there in the future too. The formula for calculating goodwill by weighted average profit method is goodwill is equal to total weighted profit upon total of weights into number of years purchase. The weighted average profit method is justified to be a good method of valuation of goodwill because the past profits show the trends of financial performance, which is the trend of profits. This method is said to be an appropriate method because this, according to this method, the profits, the past year profits which are taken into account shows the financial position trend of a business organization. Profit earned by an enterprise in recent years is more relevant as compared to earlier years. So some recent year profits are more important than the other years. Therefore, more weightage should be given to recent profits, which is followed under the method. Weighted average profit is considered better as compared to simple average profit method as it gives more weightage to the profits of recent years. So this method is said to be more important in comparison to average profit method because it gives more weightage to the profits of recent years. This method is particularly effective when profits show rising or falling trends. Then the next method is super profit method. Similar amount of capital employed yields different profit for different enterprises. When a same amount of capital is employed in an industry by different firms, but the profit that every firm is earning is different. When a similar type of business earns profit at a certain percentage of the capital employed, it is called normal profit. So a percentage of profit on capital employed earned by the firm is called as normal profit. But a buyer's advantage lies in the excess of the normal return on capital employed. But the most advantageous thing over here is the excess that has been earned over the capital employed. The excess of actual or average profit or normal profit is over normal profit is known as super profit. So anything which is above the normal profit is called super profit. Capital employed. Capital employed means capital invested in the firm to carry on business. It is calculated to determine the value of goodwill. Capital employed may be calculated by liability by two approaches. Number one, liability side approach. By this, capital employed is equal to capital plus reserves. minus goodwill, if any, existing in the books, minus fictitious assets, minus non-trade investments. Non-trade investments are those investments that are made to earn revenue by investing surplus funds and not for the purpose of furtherance of own business. So non-trade investments are those investments that are made to earn revenue by investing surplus funds and not for the purpose of furtherance of own business. So when the investments are done in securities and those securities are sold off and the main purpose behind this is to get the money after selling the securities and invest it in the business. It is called as non-trade investment. On the other hand, trade investments are those investments that are made in another enterprise for the furtherance of own business. Then unless investments are specified to be trade investments, they are taken as non-trade investments. Sometimes an average capital employed is considered for calculating value of goodwill on the basis that profit is earned during the year and capital employed changes from time to time. Goodwill under this method is calculated by multiplying super profit with the agreed number of years purchase. For calculating goodwill under this method, the formula is goodwill is equal to super profit into number of years purchase. Super profit is equal to actual or average profit minus normal profit. Normal profit is equal to capital employed into normal rate of return divided by 100. Now the difference between average profit and super profit on the basis of meaning. Average profit, it is average of the profits of past agreed years. Super profit, it is the excess of average profit over normal profit. Number 2, normal rate of return. On the basis of normal rate of return, in case of average profit, normal rate of return is not relevant in the calculation of average profit. In case of super profit, normal rate of return is considered while calculating the super profit. The third basis of difference is average capital employed. Average capital employed is not considered while calculating average profit. In case of super profit, average capital employed is taken into account while calculating the super profit. Now the fourth basis of difference is relevance of valuing goodwill. Average profit is relevant for average profit method, super profit method and capitalization method, all the three methods of valuation of goodwill. In case of super profit is relevant for super profit method and capitalization of super profit method of valuation of goodwill. The third method of valuation of goodwill is the capitalization method. Under the capitalization method, goodwill can be valued by using two methods, that is capitalization of average profits and second capitalization of super profits. So the first one, capitalization of average profits. Under this method, goodwill is calculated by deducting capital employed, that is net assets as on the date of valuation in the business, from the capitalized value of average profit. So on the basis of normal rate of return. So from the capitalized value of the business, we will subtract the net assets. Capitalized value of the business is determined by capitalizing average profit earned at the normal rate of return. Therefore, goodwill by this method is equal to capitalized value of the business minus net assets, and the capitalized value of the business is calculated by the formula average profit upon normal rate of return into 100. Net assets is equal to all assets other than goodwill non-trade investments and fictitious assets at their current value minus outside liabilities. Now the second approach is capitalization of super profit. Under this method, goodwill is calculated by capitalizing super profit at the normal rate of return. The super profit is divided by the normal rate of return to capitalize them. Therefore, as the first step, the super profit is determined on the same basis as is determined under super profit method, which is capitalized at the normal rate of return to determine the value of goodwill. Thus, goodwill is equal to super profit upon normal rate of return into 100. Now, the accounting standard 26. Treatment of goodwill issued by the Institute of Chartered Accountants of India. According to Accounting Standard 26, goodwill should be recorded in the books of accounts only when some consideration in money or money's worth has been paid for it. So, if certain amount of money is being received or has been paid for the sake of goodwill, then only it will be considered in the books of accounts. Accounting Standard 26 deals with intangible assets. Para 35 states that internally generated goodwill should not be recognized as an asset as it is not. Identifiable resource controlled by the enterprise that can be measured reliably at cost. Thus, following AS 26, goodwill should not be raised in the books of accounts in case of admission of a partner, retirement of a partner, death of a partner, change in profit sharing ratio among existing partners. This is so as no consideration in money or money's worth is paid for it. However, if any partner brings premium over and above his share of capital at the time of admission, such premium should be distributed among other partners in their sacrificing ratio. If goodwill is evaluated at the time of change in the constitution of the firm by way of admission or retirement or death or change in profit sharing ratio, goodwill would not be brought in the books. The value of goodwill would not be brought in the books. The value of goodwill should rather be adjusted through partners' capital account. From the session 2019-20 onwards, CBSE has prescribed that goodwill be adjusted through partners' capital or current accounts or by a raising and writing of goodwill account. When capital account is raised in the books and later written off immediately, it means it will not be taken in balance sheet. Since ICAI and ICSI have not suggested the raising and writing off method of treatment of goodwill in their study material, as it violates Accounting Standard 26, but since CBSE has adopted it from the session 2019-20, so this method should only be used if it is specified in the question that firm decides to raise and write off the goodwill.